Good morning, ladies and gentlemen. I'm delighted to see you, so many of you today here in Malta for our 6th years International Conference of Insurance Europe. My purpose today is to share with you some clear, constructive, but at the same time realistic messages about the most important issues affecting the insurance industry at the European and global levels. We are all aware that we are living throughout an important period in which we are trying to consolidate economic stability against a background of change. In such an environment, preserving the fundamental role of the insurance industry as a transferer of risk and as a long-term investor should finally become a common goal. And a priority in achieving this result is the need for balanced, clear, and consistent regulation. I have always been committed to promoting quality regulation. Fairness, clarity, and efficiency must be encouraged at all levels in order to help insurance companies to really protect customers as well as the whole economy. Moreover, we will continue to convey to legislators, investors, the media, and the general public the vital need to properly take into account the distinctive characteristics of the insurance business. After stating that, let me start with one figure, 130. Indeed, 130 is the number of initiatives affecting the insurance industry, directly or indirectly, that came out of the mandate of the Commission during a last 5-year mandate. This means 26 initiatives every year, or more than two every month. Last month, the Commission published an economic review of its financial regulation agenda of the last 5 years. It listed 40 proposals, most adopted and some already in force. These are initiatives addressing directly the financial sector and don't take into account all the other proposals that also affect insurance. As everyone knows, insurance is involved in every aspect of society, from birth to death, from big business to small, and from macro issues such as climate change, right down to nanotechnology. That means that there are a lot of legislative proposals not specifically targeted at insurance, but that can have a significant impact on the insurance business. And so we come to these 130 initiatives. And I commend the Commission for the huge amount of work and for the many positive aims that underlie these initiatives. It is clear, however, that such a large number of initiatives can also create undesirable effects, such as unintended consequences, additional costs and administrative burdens, overlaps and contradictions among local, regional, national, international regulatory requirements. The first of such effect is represented by unintended consequences. This is something I highlight in Insurance Europe annual report, which was published yesterday and which you have in your conference packs. First, the specificity of the insurance sector must be respected. In particular, the variety of insurance products, markets, and distribution channels across Europe must be preserved because it promotes competition and offers consumers greater choice so that they have access to high-quality products and services that better fit their real needs. As I said to Commissioner Barnier on several occasions, we recommend that legislators follow a proportionate and flexible approach and carefully evaluate the potential impact of any measure on markets efficiency and consumers before they are adopted. Secondly, we believe that consumers need better information and not just more information. We cannot accept that as a result of European requirements, a broker proposing a unit-linked life insurance product at distance has to provide 70 sets of pre-contractual information, or even more in the future. I want to state clearly, this does not benefit consumers. We will therefore continue to oppose initiatives that distract customers from paying attention to the key elements of an insurance product, such as coverage, such as exclusions. For example, concerning the prevention of potential conflict of interest, why imposing at European level the provision of complex and technical data on the distribution remuneration when it would be more effective to disclose the source and nature of the intermediary remuneration? At the same time, duplication, overlaps, and lacks of alignment between legislative initiatives must be avoided. For example, we are concerned about the duplication of information requirements between Solvency II and the PRIPS regulation. It does not make sense that consumers receive the same pieces of information twice in two different formats. This is not a minor issue. An excess of information can confuse and mislead consumers, have a negative influence on their ability to choose, and therefore distort the demand and the supply of insurance services. Now let me take another example of unintended consequences chosen from legislative proposals that are not specifically targeted at insurance, but can have a significant impact on the industry. And this is the data protection reform. The European Union is carrying out a review of the European data protection legal framework, which is still under discussion. Here again, Insurance Europe supports the general aim to harmonize legislations and reinforce individual rights. However, we are concerned that the broad reforms have been designed without considering their impact on specific sectors, such as insurance data processing activities. Yet data processing and analysis lies at the heart of the insurance activity. If the revised legislation prevents us from collecting and using data to assess risk, evaluate claims, and prevent frauds, we will not longer be able to offer the cost-effective, tailored, and innovative products that consumers need and expect. For instance, the right to be forgotten, introduced in the Commission proposal, would allow customers to require insurance to erase all their personal data from the database. It could result in insurance being unable to process data, preventing the performance of contractual obligation, and forcing the deletion of data that other regulations require or that is needed to detect fraud. So we will continue to explain to legislators that insurance has its own very specific model and needs, which must be respected for the sake of both consumers and the functioning of the market. Referring back to my introduction, it is clear that so many legislative initiatives may also have a significant impact in terms of additional cost and administrative burdens. This complexity negatively affects productivity, in particular that of small companies and distributors. Another very concrete point is that, of course, those 130 initiatives are only the ones worked out by the European Commission. There are also national initiatives to which insurance need to respond, and the increasing number of action taken globally. Overlaps and contradiction among national, regional, and international regulatory requirements have to be avoided. Otherwise, there will not only be greater cost and a higher administrative workload, but also legal uncertainty, compliance concerns, and reputational issues. And we do not want this. We do not need this. On the subject of international requirements, I immediately turn to a very important issue in our conference program. This afternoon, we have a panel debate on the most pressing global initiatives. The work of the International Association of Insurance Supervisors on Global Capital Standards. We will hear from Peter Braunmiller of the IIS and from Svein Andresen of the FSB, the two international organizations that are driving the ambitious timetable to develop 3 capital standards in less than 3 years. We are only 5 months away from the planned endorsement by the G20 of the basic capital requirements for insurance identified as globally systemically important. And the IAS is due to finalize the insurance capital standard that will apply to international group by the end of 2016. So the coming weeks and months are critical, and there will be limited possibility for the industry to provide input on the standards. However, one of the lessons that we learned from Solvency II is that the definition and the development of capital standards that work as intended is not an easy job. If we want capital standards to be not just numbers, but actual effective protection mechanism, we need analysis, studies, proposal, and long discussions with all the parties involved. But most of all, we need time. And time is what is missing from the ambitious deadline set by the IAS and the FSB. Without sufficient time, there will not be any analysis, any proposal, and any discussion, thus reducing dramatically the chances of having effective new capital standards. I asked Commissioner Barnier for a meeting last February and explained to him the concerns of the industry and the need for the involvement of the European Commission. I am glad that after our discussion, the European Commission recently decided to organize a wider meeting with representatives of the industry. I hope that this constructive dialogue will continue. We call on the European policymakers and institutions to bring greater political accountability and transparency to the discussion at international level, and we welcome steps taken by the Commission to start this process. We would also like to express concerns about unduly high levels of regulatory capital, given the detrimental effect of additional capital lying inactive on insurance balance sheets. It is also equally important for the European insurance industry that the outcome of the work on international capital standards is compatible with Solvency II. Solvency II is a sophisticated, risk-based regime and represents a fundamental review of the European supervisory framework for insurance. It must therefore be possible to treat it as a practical implementation of the global standards. I think that the main objective of Europe should be to ensure that Solvency II can be consistent with the principle under the ICS project. And that leads me to the second figure. The first was 130. The second divides that number by 10. So 13. That's so how many years we have been all working together towards Solvency II. It's tempting to think that the work is done, but this is not the case. I will spare you more numbers, but there will be many consultations on implementing technical standards and guidance over the coming months. Frequent revision will follow too. There is also the considerable work involved for companies to put the necessary systems and processes in place in order to comply with the requirements. The Omnibus II agreement that was reached last November by the EU Council, the Commission, and the European Parliament, led by Rapporteur Balz, who I welcome here, thank you very much, Mr. Balz, to be with us today, updates Solvency II in important ways, and it was a great achievement. We worked hard to demonstrate why our proposal, reflecting the way the business is managed, were needed to protect the ability of insurance to continue offering long-term guarantees and to safeguard the insurance industry role as Europe's largest institutional investor and as a provider of financial stability in volatile markets. While not exactly what the industry has been proposing, we recognize that the Omnibus II agreement was a major achievement and that it was in all our interest to end the uncertainty and move ahead with Solvency II. If implemented correctly, the Omnibus II measures can reflect the way we manage our long-term business and avoid unintended consequences. This is because these measures can help to avoid overstating the risk to which our balance sheets are exposed and reduce the problems of exaggerating the real volatility identified in the quantitative impact studies and impact assessments. Provisional figures that Insurance Europe released yesterday revealed that insurance had an estimate 8.6 trillion euros of assets under management at the end of last year. Therefore, getting this right was important not just to the policyholders, but for European growth and financial market stability. With the directive agreed, focus shifted to the implementing measures. This includes delegated acts, implementing technical standards, and guidelines. Insurance Europe originally identified over 100 concerns with the draft Solvency II delegated acts that set out the detail of the directive. In view of the tight timetable to keep Solvency II on track, we nevertheless restricted our focus to 8 top priority issues, in particular related to long-term guarantee and investment issue. Among the long-term guarantee measure, the volatility adjustment is the one of utmost importance, and as such, its definition is one of the key industry priorities. The directive sets only the high-level principle for the volatility adjustment. So it is in the delegated acts and in the implementing technical standards that the real capabilities of the volatility adjustment are established through the definition of the methodology of its calculation. The methodology adopted should be set acknowledging the 2 main goals that are the basis of the Omnibus II agreement. The first one is that the amount of the volatility adjustment should ensure its effectiveness in protecting the industry from short-term market volatility. The second goal is the need for transparency and clarity in the formulas and parameters adopted. Without a full and deep understanding of its calculation, the volatility adjustment will not be replicable and predictable, and therefore will not be embedded in the industry key risk and capital management processes. To conclude the Solvency II chapter, even if the principle included in the directive seems to work in the right direction, the key point is correct implementation. And Insurance Europe will analyze carefully the final version of the Solvency II delegated acts and all the technical standards and guidelines to make sure that they are in line with the spirit and the letter of the Omnibus II agreement. It will also be important to monitor how Solvency II works in practice and take action if it turns out that the measures included do not prevent the unintended consequences. Approaching the conclusion of my contribution, I would like to draw your attention to the new Commission, the new European Parliament, and all the challenges that lie ahead. Next, we will hear from Commissioner Barnier about the achievements and legacy of the current Commission. And given my nationality, I particularly look forward to engaging with the incoming Italian presidency of the EU, which could have long-term investment issue, data protection, and the revision of the Insurance Mediation Directive on its list of priorities. In this rapidly evolving scenario, Insurance Europe also awaits the European Commission reports on the reform of the European supervisory authorities. Here we underline the importance of maintaining the current model of separate supervision authorities so that the characteristics of the different sectors can be better understood and recognized. In addition, we hope to be able to continue and reinforce the dialogue and cooperation with EIOPA, sharing data as well as opinions and expertise. And I am delighted that Gabriel Bernardino is with us today to contribute to our debate. Huge adjustments lie ahead for our industry. Regulation will form an even bigger and more complex part of insurance operation. The regulatory environment defines our operation, our customers, and our liabilities. So it is essential that we engage constructively as an industry to ensure that this environment is solid, trusted, and fit for purpose. Insurance Europe has built up a strong working relationship with the EU institution, and a positive and constructive dialogue will surely be developed with the new representatives. We are ready to engage with them to explain how insurance works and why insurance are different from other financial institutions. At the same time, Insurance Europe had similarly good relations with the global bodies that influence our industry. It has done both independently and through its membership of the Global Federation of Insurance, led by Frank Swedlove, who is here also today with us. Despite these challenges, I am optimistic, and I repeat, I am optimistic, that Insurance Europe's open and constructive engagement with policymakers, legislators, and supervisors, and will contribute to the global and European frameworks that allow our distinctive and innovative sector to grow, continuing to protect and serve the needs of its customers. As many of you know, the Football World Cup opens in Brazil today, just after conclusion of our conference. Who will win this global competition? You know, I hope that my country will do what he can. But we don't know. But I'm sure that teamwork and shared goals are the secret of great results. And this is my warm wish for all of us, and thank you very much, and enjoy this conference today.